Okay, fine. Well, I hope that you'll get that information.
I need to get in touch with you sometime, Bob, and send you a lot of this information.
Okay, thanks very much.
Well, if you can email me, that would be great.
Get somebody else, Bob. You must know somebody who's got an email that could at least get in touch with Bob that way. Okay, thanks so much. Let's go to Tom. Tom calling from Chicago. Hi, Tom. Have a question or comment?
Yes, always enjoy listening to you, Bob, and of course, Dr. Stan. I just was wondering, Bob, in our newsletter from last week, I took some recommendations that you had. One was Middlesex Water, and another one was an iShares for a mortgage company. And I was just wondering your thinking on those items, because usually you would never touch a mortgage company. And the water, you had a couple of suggestions about water company.
Well, the water company, yes, but the other one I'm not aware of.
Oh, really? I hope I did the right. I hope I got the right symbols. It's an iShares?
I think you didn't. And I think you should email me and tell me what you did, and I'll tell you, I'll help you do the right thing or what I had recommended. But I've been short mortgage companies for the last 3 or 4 years.
Right. That's why I was thinking it was very, very funny that.
I did. You must have misread it. The water company is the only thing. With the water company, I've been long those stocks for 5 years, and they've gone nowhere. And nobody's interested in water, of course, until they can't have any. But it's been a very disappointing investment. People haven't lost money, but it's just been a stale, neuter investment. And I hope it doesn't continue that way, but that's the way it's been.
And the volatility keeps going with our with the recommendations that you've had for Silver Standard. It went down to 2050 today, and it rocketed all the way back to close to what it started out at. So,
yeah, they all did that today. And the stocks are telling you we don't think gold's going any lower here. That's what that was all about. The stocks are starting in the last several months to lead the market away. They lead the gold price the way that they did for years and years. I've been doing, things associated with gold for almost 50 years now, and the gold shares always led bullion, and it's happening again. And you get the perennial question: well, if the stock market's going to go back down to 6,600, will it take the gold shares with it, the silver shares? And the answer is no. You might get some selling at the beginning of a decline due to margin requirements. But other than that, they're going to perform because gold's going to go up. And the stocks will go up anyway, the gold and silver shares will. And so that's the way that should turn out if history's any indicator.
Okay, anything else, Tom?
No, thank you so much, Bob and Dr. Stan. Always a pleasure listening to you.
Good to have you with us. Okay, fine. This is Dr. Stan. Our telephone number is 1-888-24-LIBERTY, 1-888-24-LIBERTY, or 464-8295. And basically what you're witnessing is the contraction of our entire economy. So many of our stores, certainly they're not selling as much as certainly even major stores, Macy's, Target. I mean, their sales are down, and certainly the sales in so many of our major corporations are down. But our factory production is off on most things, isn't it, Bob?
Yes, and it's the same way all over the world. And if you look at the dry index, you'll see that, and I print in those figures. I had them in the last issue for around the country, and now I just saw some more that came out I put in that were rail car loadings and that sort of thing. And then I understand there's new figures just came out, and they're even worse than ones that I put in the publication the last week or so. It's off about 20% in shipping of one form or another.
And of course, you commented that certainly the Baltic Dry Index was up a little bit, but that was primarily because the Chinese were bringing in, commodities from out the world. They've got all this money. They want to get out of the dollars. They want to dump their dollars, and so what do they do with them? They're buying up commodities, copper, iron, ore, all the things that they'll need at some time in the future, and kind of store them there, waiting for a long, long time probably for the market to change itself. But then the Chinese, of course, always plan ahead, dozens of years, sometimes even centuries. So that's the only reason the Baltic Dry Index is going up. The Chinese are dumping their dollars to buy commodities, something of intrinsic value, because they realize that paper money is well worth sometimes not even the paper it's printed on. Well, this is Dr. Stan. Of course, our guest has been Bob Chapman. We hope you enjoy our afternoon program with Bob. Listening to, they happen to be my views, and for the next hour, they're going to be the views of Bob Chapman of the International Forecaster, as we do always on Monday evening, trying to keep you abreast of what's really going on financially in the world today. And I would simply point out that reality is usually scoffed at, and that illusion is usually king. Probably no better place is that exemplified. That in an article I read just now in the New York Times, came out a couple of days ago, talking about the latest statistics and how great they were. After all this last month, in much of May, we only lost 345,000 jobs, and that was really so much better than the month before that, when we'd lost 540,000 jobs. Of course, they forgot that the previous month when it came out, that was in April. Why, of course, the figures showed about 360,000 jobs were lost, and now they upgraded to 540, and now they tell us, boy, it's a lot better now because it's only 345,000 in comparison with 540 last month. But they forgot that they adjusted those figures from last month. And then, of course, what they really need to do is point out we're making new jobs. Well, they insist we're at the bottom of the cycle. Things are going to start up now because, of course, we're losing less jobs than we did before, but we're not creating new jobs. You're not at the bottom of the cycle before you begin to create a lot of new jobs, and you're creating more new jobs and you're losing jobs. But you see, well, if you control the media, you can make people believe almost anything you want to, and that's really what they do. They can make you believe that black is white, that tall is short, that fat is thin, that good is bad, and there are an awful lot of people out there who accept it because they read it in the newspaper without ever stopping to think that we're a long way from the bottom of this recession. It's not beginning to improve. Certainly it's going to be with us for a long time. More people are losing their jobs. 345,000 people lost their jobs last month. We're up over 9.4% in unemployment rate, and of course that, as Bob I'm sure will tell you, is a gross understatement, intentionally designed to confuse you about how bad things really are. And, of course, they're going to get a lot worse because everything that the Treasury and the Federal Reserve are doing today is designed to make things worse, but they can't let you know that. They've got to make you think they're doing everything they can to solve the problem. But if they solved the problem, there would not be chaos. There would not be a demand for a new world order. And that, of course, is exactly what this is all about, which is why they precipitated this whole financial scenario at this time in history. Bob Chapman, thanks very much for being with us.
Well, you're welcome, and it's nice to be here this evening.
Why don't you pick up the story and give us your impression of the latest economic statistics, which are trying to convince us that we're now at the bottom, we're probably at the bottom, we may be at the bottom, but things may be looking up.
Well, I don't think they're really looking up. I don't think they're going to look up for a long time. And what you're seeing is a reduction in the minus side of GDP. It was 6 3/8 minus in the fourth quarter, 5.7% minus in the first quarter. Looks like probably a 4% in the third quarter, and it should stay there for the remainder of the year. And then I think next year, because of the stimulus that's been planned.
Hold that thought. We're going to be back here in just a moment with Bob Chapman.